Thank you so much, Melissa. Well, a new report just out this morning has energy speculators back on the defensive. The report saying that speculators, they are the ones that caused this year's big spike in oil prices. Well, is this really a viable claim? Here to weigh in, we have Dennis Gartman, founder of the Gartman Letter, Dan Weiss, Center for American Progress, Senior Fellow, and Director of Climate Strategy. That is quite a title there for you, Dan. Also, today's guest contributor, Paul Kudrowski. Guys, welcome to all of you. Now, according to this report, in the 5 months from January through May, traders poured $60 billion into the commodities markets. And basically, per the report, they caused a big spike in oil prices. My question to you is, Dennis, well, so what? So what? They invested in oil. Oil went up. What's wrong with that?
Well, there's nothing wrong with it. They invested in oil, they invested in wheat, they invested in corn, they invested in copper, they invested in gold. After 3 years of committee meetings, the endowments and the pension funds of the world finally bought into the notion that this is an asset class. I think they were wrong. They bought the highs, Trish, and now they're liquidating and getting out. So I think that the movement to the long-only funds extended and made the price movement on the upside on all commodities overextended, and now you're simply getting the obverse of that.
In other words, it is your belief that this is a market functioning as a market should function. However, Paul Weiss, you don't buy it.
Dan Weiss, no.
Oh, forgive me.
I don't, and in fact, what happened is that this study confirms what other studies have already shown, which is that there's up to $30 a barrel of the price of oil is speculation. And that had real costs on real American families who are already squeezed with a declining income and high health care and food costs.
Dan,
so this did exact
right
a real cost right now on people. And, you know, the Saudis profited and big oil profited, but Americans...
they're taking it out now.
What's up?
They're taking that price out now, Dan. It's down to almost, we're going to be at par here in another hour.
That's right, but in the meantime, there was a huge transfer of income from people who bought gasoline between last January and now, paying a price that was jacked up by speculators. The reason why this price started to go down is when it became clear that Congress was going to be serious about cracking down on speculators.
What would you have the CFTC do about it? Well, where do you draw the line and say, okay, you know what, this is where we stop. This is a little bit of speculation's okay, but this is too much. Let's stop here.
First, let's make the trades more transparent. Second, let's get the CFTC more staff to oversee transactions. Third, let's make sure that companies have to put up a bigger margin. All these things would help us rein in speculators that clearly drove the price up. They got their money. They got out.
There are certainly plenty of people that made money, and there are certainly plenty of people that lost a ton of money when oil fell back to the levels we're seeing it at now.
Yeah, the people who lost money are the ones who are late in the game, but the real people lost money were middle American families who had to pay $4 a gallon for gasoline, and the people who really made money was ExxonMobil and Saudi Arabia and the speculators.
Yeah, I mean, let's get back over to Dennis here. Dennis, I mean, if you don't have a market that allows people to jump in and buy when they think, even if they are speculators, they think something's going up, what kind of market do you have? You
need speculators, Dan. We are the ones who facilitate hedgers to be able to get in and get out of markets. Speculation has been going on for thousands of years. It's going to continue to go on. And perhaps there was a little excess on some of the endowment funds and the pension funds who bought in a little too late. And Dan, you're absolutely wrong. They did not get in early. They got in very late. Believe me on that one. I sit on some panels. I know the decision-making process that goes on. It took them a long time. They own it at the highs. They do not own it at the lows.
I mean, Paul, this is kind of just sort of, unfortunately, the way things go. I mean, you tend to see, I mean, look at technology. Can you say, okay, we're going to regulate against people getting enthusiastic about a particular sector?
Well, what worries me in particular about some of the suggestions that are being made with respect to this is the idea of banning some of the non-commercial traders or limiting some of the non-commercial traders, meaning financial so-called speculators in this marketplace, and just limiting trading in some of the commodity futures to those people who can take delivery, commercial traders. And I think that's particularly dangerous. It's an insidious idea. It sounds appealing. Get the speculators out. But then all of a sudden we have all these people who want to hedge other positions who no longer have the ability to hedge it, and we create new risks.
Trish, the oil prices have suffered this year, and middle American families have suffered from speculators gone wild. This market is less regulated than other areas. Under stocks, you have to put up a 50% margin. Here, it's 5%. Let's change that. There's not enough overseers over at the CFTC. Let's change that. There's not enough transparency in trades. Let's change that. When it appeared that Congress was going to crack down on speculators, that's when they started to get out of the market. So let's put in those rules in place and make sure that we don't have such a run-up again, because although maybe people you deal with didn't suffer from this, real Americans did.
Dan, I mean, would you say that this is something, all these different strategies that you just ticked off, is this something that should be in various different kinds of markets? I mean, what about the sugar market or the coffee market or the corn market or you know, any other commodity that you look at? Well, or would you say just oil? Well,
oil is important because right now there's no other substitute for it. You know, sugar, there's corn syrup, there's other substitutes. If you don't eat corn, if corn goes up, you eat wheat, you know. But oil, there's no substitute for right now. Okay. And really, what we really need is to, as George Bush said in 2006, is to get off oil so we're no longer dependent on this product. But until that happens, we need to crack down on speculators gone wild, which is what happened this year, which is why Americans were hurting so much.
We need to crack down on socialism gone wild.
Here. Yeah, tell me, hang on, Dennis, what would happen in that kind of environment? If we saw that kind of regulation within the commodities market, what would that mean for oil prices?
The oil prices would be, excuse me,
let Dennis answer the question here. Dennis?
If you limit the number of speculators that are allowed to trade in a market, what you'll end up seeing is that the bid and offer for crude oil, instead of being a 1 or 2 cent market, will go to a 15 or 20 cent market. The ability for grain elevators to hedge inventories, instead of a 1/4 cent bid or offer, goes to a 2 or 3 cent bid or offer. You lose the ability to export grain. You will lose the ability to price crude oil. You will make a seemingly illiquid and volatile market become imminently more illiquid and imminently more volatile.
Okay, that's the risk we face. We thank you so much, Dennis Gartman, Dan Weiss.
Thank you.
Paul Kudrowski, stick with us.